In this video, I interview Rick Rule. He's a famed natural resource investor, one of the most successful in the world. Regular on the show now, coming on to do a regular interview and Q&A. So I sourced your questions in this from comments that you left down below. So today we talk about how he made his first $1 million. We talk about the gold and silver markets. We talk about when he bought his first rental properties and how he was able to become a multimillionaire and then actually lose his millions, and then how he made it back many times fold. We discussed his investing principles of Warren Buffett to become rich and successful as an investor. So this is a fascinating interview that you're not going to want to miss. Make sure you hit the like button right over there on this side and this side. If you have questions as you're watching, you can leave them in the comments below. We will source them for his next appearance back on, where he'll do his next Q&A. So you can leave questions down below. He also has sprottusa.com/rankings, which is in the description right there down below. Well, he will do a free portfolio review of your natural resources stock portfolio. So pretty cool. You can check that out right down there below. sprottusa.com/rankings in the description. Hit the like button right over there. Enjoy this interview with one of the most successful investors that we have the privilege to connect with on the channel. So today we have famed natural resource investor Rick Rule back, and he'll be coming on now more regularly. So first thing I want to say is if you have questions, things like that, you can always leave them in the comments below and we will source them and use some of them for future ones. So thanks for joining, Rick.
Always a pleasure. Thank you for having me back.
All right, first question. Did you know that futuremoneytrends.com says you're a billionaire?
I think what happens is that on many sites, they get a lot of responses if they say billionaire. The truth is, if you're measuring my wealth in US dollars, I'm not a billionaire. Now, if you measure my wealth as Future Money Trends may be doing in Zimbabwe dollars, I probably am a billionaire.
You'd probably be a gajillionaire in Zimbabwe dollars. All right, so let's start with gold, just because there were some questions about it, and we'll cover it real quickly. And we've had a little bit of a consolidation, and although miners have held up pretty well, what's your views on how long you think that'll unfold? Do you think we'll stay in this pattern until we get a new stimulus? What's your quick thoughts on gold?
Jake, we talked the last time you interviewed me about the fact that gold isn't merely cyclical, it's also volatile.
Yeah.
The fact is that that gold itself and the gold stocks can fluctuate up or down 10 or 15%, the same way that you and I inhale and exhale. So in truth, probably when I was your age, I thought about it a lot. And I don't think about it at all anymore. I believe, for the reasons that we discussed in the last interview, quantitative easing, negative interest rates, debt and deficits, and the fact that gold and gold stocks are so broadly underowned, that the trend is higher. That will certainly be punctuated by cyclical declines in a secular bull market. But the truth is, I don't think of it at all. If the down cycle is severe enough, I use it as a buying opportunity. The truth is, in the last 2 weeks, some of the junior gold stocks have escalated in price so rapidly that I've been a seller. I would welcome a decline by 25 or 30% in price, which could happen in the juniors, so that I could buy them back more cheaply. But the truth is, when you look back at the history of gold bull markets, which is what I believe we're in, the first one that I was in took 11 years to work through. The second one took between 8 and 11 years to work through. By my counting, we're 2 years into this one. If past is prologue, we've got a long way to go. People ask, and I'm sure your readers ask you, well, the gold prices moved from 1,100 to 1,900. I mean, have I missed it? Well, in the 2000 to 2011 timeframe, where the fiscal circumstance was nowhere near as dire as it is today, the gold price moved from $250 an ounce to $1,900. Will gold move sevenfold this time? I don't know, but the fact that it's up by 80% doesn't bother me particularly.
Yeah, that's very sobering, and I think it important for a lot of people to understand. And it's interesting is that you mark us as 2 years in to this rally. That's fascinating. Well, is that your estimate just off of we finally really seen it pick up around like 1400 or what?
I don't have an estimate. It's just my experience.
Got it.
When I look back at the chart that I so often reference for your audience, the Barron's Gold Mining Index, you can see in the chart very clearly 8 recovery from oversold bottoms. But what's much more important is that you can see 2 epic bull markets. And those markets lasted 10 or 11 years. Will this one act the same? I don't know. The only experience I have is the 2 that I've lived through. I think the more important thing to focus on, Jake, which we did in the last interview, is what would cause me to begin to revisit my premise. In other words, I don't make price predictions on gold or gold stocks, but if we saw a return to positive real interest rates, if the US 10-year Treasury was yielding 250 basis points or 300 basis points of positive yield, that is above the underlying rate of inflation, then I would begin to think that enough fiscal discipline had returned to the market that I could revisit what I'm doing with gold. A second marker would be if the market share of precious metals and precious metals related assets in the US market returned to something north of 2%. Right now it's about 0.5%. In other words, if gold stopped being so stupidly underowned, then I would re-examine my premise. I'm not saying I would sell, by the way. I'm just saying I would revisit my premise. If you had deeply negative interest rates and gold's market share was still below 1%, I would know that the most likely antidote to the disease was still underowned, and I'd stay along. But until then, this is probably the last great gold bull market of my career, and I'm going to enjoy it.
Very well said. Thank you for that. So when was the first million? How old were you when you made your first million, and how did you make it?
I was in my early 20s, and I really made it 2 ways. When I was in university at the University of British Columbia, I had to have a job because I had no money. And so I got a job as a bouncer in a bar.
Really?
Through an odd series of circumstances, while I was still in university, I ended up owning a bar.
What?
It's odd. And it turned out I was pretty good at it. And so the same time I was doing that, I was enjoying very, very, very steady cash flow from the bar. I had a product that cost $0.25 and sold for $1.50. It was a pretty damn good product. And people liked it. It needed refills and it was habit forming. It was a great product. And so I did 2 things. I began to invest in natural resources, early stage often. And at the same time, in the early 1970s, real estate was really cheap in Vancouver. And you could buy duplexes or triplexes with 25% down. You could buy them for 100 times their monthly rent.
Whoa.
And, I was too young to understand that real estate went up in price. I just thought if I bought it, that over 20 years or 30 years, the renters would pay off my mortgage, and then I'd own the property free and clear, and that would be my retirement. I was really pretty unsophisticated. I also learned that if I bought a rundown place, that I could fix it up and increase the rents. So really 3 things happened for me. This bar made me great income. To the extent that while I was still in university, I was making 3 or 4 times what tenured professors were making from the bar.
Wow.
And I was able to buy these duplexes and triplexes and fix them up and increase the rents. And it's really cool to be in a business where every year your rents go up a little bit, but your cost of capital stays the same. So the delta between cost of capital and return on capital employed widens. Now, it never occurred to me that real estate prices would increase because I wasn't a real estate guy. And over 10 years, that was all icing on the cake for me. And then, of course, I was lucky enough to be in Vancouver, which was the epicenter of speculative natural resource stocks in the greatest resource stock bull market that one could imagine. I mean, things like Coeur d'Alene mines over the course of 10 years went from 10 cents to $64. So the conjunction of those three things meant that my first million came pretty quickly. By the way, it went away pretty quickly too, after that market collapsed.
It sounds like you made more than 1 million then that early. So, so you took the money from the bar, and then while you were still in college, you bought the real estate, and then you rolled over a bunch of money into the commodities bull market that was happening?
Yeah, and I also, got involved sort of as a finder. When I started being successful in the natural resource business, both in the oil and gas and mining business, people who were very successful but needed help telling the story or as a money raiser, mercifully, including Adolf Lundin, who went on to become a billionaire himself, began to hire me. And I was smart enough, not needing any money, that I worked on a success basis. I said, you don't have to pay me. If I accomplish this goal, you have to give me X amount of the company or a carried interest in the well or whatever. And a couple of those were just really, truly, stupidly successful. And the fact that I had the courage not to take cash meant that people who wanted to employ me, where I worked on a successful efforts basis only, and I worked for equity, not for money, it meant that they trusted me. And it also meant when I was right, which I was fairly frequently, that I got paid insane amounts of money, which is fun.
So this was all in your 20s?
Yeah.
Oh, yeah. Man. And what was it like losing millions of dollars?
Well, that was less fun.
In your 20s?
That was a lot less fun. I made the mistake that's common to a lot of young men, I think, where there's more testosterone than serotonin in the system. And I sort of confused a bull market with brains. The gold price went from $35 to $850. Coeur d'Alene went from 10 cents to $65. And I thought somehow as a consequence of that I was smart. I just, happened to be out in a sailboat race with a bunch of wind in my sails. The other thing I did is that I didn't understand how cyclical resource businesses were. And I let the price signals justify the narrative. I forgot that markets work. All the big thinkers in the world at this point in time, people mercifully you've probably never heard of, Jeremy Rifkin, Jimmy Carter, the Club of Rome, all these big thinkers were Malthusian. And they all said that the population growth of the world meant that by the year 2000, that the world would be out of natural resources, that oil would be $200 a barrel, and 50 million people a year would be starving to death, and all this kind of stuff. And this resource scarcity theme suited a young man who was developing a reputation in natural resources. So unfortunately, I came to believe it. But markets do work. The cure for high prices is high prices. And come 1982, interest rates were at record highs, the economy crashed, and the natural resource business really crashed. And of course, my focus was on natural resources. And being a young man, I had a lot of debt. So my interest expense rose at the same time that my principal values declined. And I went from being a very hubris-ridden and very rich young man to being a somewhat more humble young man with a net worth that was below zero. And I have to say, it wasn't fun. But I also have to say that I'm glad it happened early in my career, because there's nothing at all like taking deep, deep, deep wounds like that to teach you a lesson, that lesson being that markets work. That the cure for low prices is low prices, and the cure for high prices is high prices. And that lesson has stuck with me ever since. And while it's unfortunate that it took a lesson of that severity to cause me to understand what I do for a living, I'm still grateful that I learned it, because the business has served me very well ever since.
Interesting. So that all your sayings that sound more like just commonplace cute sayings. You really actually saw them actually happen in your life.
Imagine going from a very proud, very rich young man to being upside down.
That's funny.
Going from having a reputation as a genius, which in your 20s is fun, to having a reputation as a moron, which, while deserved, was somewhat less fun.
That's funny. So when you have no money, what do you do? So
Well,
how do you start and work and grow your net worth? And if you have no money right now?
Oh, if you're curious and if you have good character, and if even people that you've lost money for, understand that you're honest and hardworking and curious, you'll come back. I had 6 principal creditors in 1982, any of whom could have put me upside down. And I got all 6 of them together, actually, and said, I'm not going to declare bankruptcy. I'm going to work until I've paid you all back, principal plus interest. Now, any one of you individually could put me upside down. And if you do, you'll eliminate the chance that the other 5 have of getting paid back. So I actually made the responsibility for my well-being a joint responsibility. A few interesting things happened. The first is that a couple of the 6 didn't know the others. They got to know each other. They liked each other. And they formed a club, in a sense. And they all stuck by me. So I had the time to pay them back. The second thing that happened is that all 6 of them admired my grit and tenacity and honesty. And 2 wonderful things happened from that. Well, really 3. They began to pass me opportunities. They were all rich, older guys with deep pockets, deep connections, and big brains. And they began to introduce me to their friends. They said, this is a unique circumstance. Here's a young guy. There's 300 young guys gone broke in the oil and gas business. And there's one who's decided he's going to do the right thing. We need to support guys like this. All 6 of them are now deceased. But I did business with all 6 of them for the next 20 or 25 years. So many good things happened. And anybody who is hardworking and intelligent and honest, who falls on hard times, needs to understand that many, many, many people fall. A measure of who you are is not that you've fallen, but whether or not you get up.
Interesting. That's very interesting. So what do you do if you're listening to this and you're like, yeah, this guy Rick sounds pretty interesting and smart, but right now I have $4,000 in my bank account and I lost my job and I don't know what to do and I want to get rich too. Like, how do I get going?
Jake, when I was 29 years old, my net worth was negative 1.6. It wasn't plus 4. It was negative 1.6.
Yeah, but it was a lot. It was a plus many in the earlier years.
Yeah, but you get my point. When somebody says, I only have $4,000, well, that's $1,604,000 more than I had. So, and by the way, at that point in time, interest rates were 18%.
Oh, wow. So
borrowing my way out of problem. Well, never mind. I mean, I was paying interest on that $1.6 million. It wasn't. It wasn't a flat number. It was a number that was growing every month. So, all I can say is that you take your steps in meaningful bites, but you never let yourself get down. I think that young people need to build a cash hoard first. You need to have 3 months worth of living expenses, cash in the bank. Because that means that you can work to get ahead rather than work to support yourself. And then the second thing, rather than worrying about money, is worrying about how you can deliver value to other people, rich people in particular. There's no better way in the world than to make rich people richer. Rich people are rich because they like money. And if you can show them that you can make them money, they are happy to pay you. There's this weird supposition that rich people are stingy. That's wrong. Rich people are generous because they're greedy and they know they have to pay to get. Poor people are stingy because they're covetous of what they have and what they want. So don't focus on getting rich. Focus on delivering value to others and showing others how you are delivering value to them. And they will pay you, and they will pay you happily. Invest in your own business first. If you ask me, Jake, what the right thing to do with X amount of money for you, I would say make sure your own business is well capitalized, because for sure you can make you more money than I can make you. Invest the surplus with me, but invest the principal with yourself and in yourself. Read a book a week. For sure, read a book a week. And if you only have $4,000, don't buy the book. Go to the library. You can you can go to the library and you get economics in one lesson. And if the library won't give it to you, Students for Liberty, if you're young, will give it to you for free. Read that book, and then read The Intelligent Investor by Ben Graham. The best investment book ever written relative to the effort required to read it. Now, you got to employ the strategies. You can't read all these bright strategies and then employ got a hunch, bet a bunch. That doesn't work. But if you do those things, you don't have to be the hardest working guy in the world. You don't have to be the smartest guy in the world. You just have to be harder working and smarter than most. And being harder working than most is really simple, because most people don't work hard. Most people, Jake, I could run a 100-yard dash and I could win against a bunch of guys in their 20s if they didn't show up. If I'm the only guy running, I win the race, And so when I say you got to work hard, most people don't work hard. And, and I'm not saying even that you ought to want to be rich. Being wealthy means that you have a life that enhances your sense of well-being. It might not be tied up around money. It might be tied up around philanthropy. It might be tied up around family. All that's good. But the lessons are always the same. You get because you gave. That's what happens. If you decide you want to be rich, financially rich, that's great. There's some steps you got to take. You got to save, as an example. There's a lot of folks who think they want to be rich, but they don't. They want to live rich. They want the flash. They want the show. They want the bling. They want the Lamborghini. They live beyond their means. When a young person comes to me and says he or she wants a Lamborghini, I say, oh, that's so sad. Why don't you want a Lamborghini dealership? You follow where I'm going with this?
Yeah, that's interesting. So let me ask you, I have Benjamin Graham on my list to discuss, but I will push that back a little. And I want to talk about his book and the most important lessons from it. But while we're still on the subject of getting rich, what do you think are fundamental principles for someone becoming rich? Or
deliver value to others. Deliver value to others. Hopefully figure out something that you like doing so well that you're eager to get to work and you resent going home. The idea in the 70s that another young man was going to compete well with me in natural resources, if he or she, if all they cared about was their car payment, they didn't stand a chance. I was so fascinated with it. That I just couldn't help myself. So, if there's something that fascinates you, that you do it for free if it didn't pay well. And if you don't focus on getting rich, if you focus on employing that knowledge for the benefit of others, you can't help but make money. You just can't help it.
So let's talk about Benjamin Graham. Let's talk about the book and the main principles of the book that you think why this is so important. Like if you were to teach a class just on this book and you were teaching investors from all industries and there was 1 million people listening and you were teaching this book, like what do people need to know? Why are you you're like, I describe you as this guy who's obsessed with this one book. So what is this book and why is it so important? And what are the biggest lessons from it we should know?
The most important thing about it, I think, is that it's easy to read. Benjamin Graham writes well, and the book was written for non-financial people. So it's accessible to anybody. I actually have better investing books on my shelf but they're harder to read. They're less accessible to people. This is where you start. It's well written and it's easy. The first principle in the book that most investors don't understand is what a bond is and what stock is. Most people think bonds are pieces of paper that pay them interest. And I guess in a sense that's true, but what they really are is a prior call on an income statement and a balance sheet. The bondholder gets paid, unless he's unscrupulous, goes bankrupt. They get paid a fixed rate of return before anybody else gets the money. Good thing. What's a share? A share is fractional ownership in a business. Many people think that shares are floating abstractions that they screw around with on Robinhood. But no, shares represent fractional ownership in a business. If there's 100 million shares outstanding and you own one share, you own 1/100 millionth of the business. And in order for the share price to have any meaning, you have to have an opinion as to value. It's the discrepancy between value and price, which is what successful investing is built on. And Ben Graham shows this very, very, very clearly. He causes you to understand what stock is and what debt is. So that's the first thing. The two sub-points he made many, many, many points, and everybody who reads the book gets something different out of it. I already knew what stocks were. I already knew what bonds were. I already knew that shares were fractional ownership in businesses. I wasn't a trader. I already knew that durable competitive advantage, whatever it was important business characteristic. All that stuff I already knew. What was important to me really came in two places. A moat of safety. Ben Graham believed that for investors, as opposed to speculators, that they should look for companies that were well financed enough and had enough durable competitive advantage that there was a moat, a margin of safety around their business. So he looked to the balance sheet before he looked at the income statement. In the income statement, he looked for margin, something where business could be bad, but they could still do well. And he looked for businesses that either had technological or geographical or some other advantage over their competitors. He looked to protect his downside before he looked to achieve his upside. And I think that was very, very important. Most investors now, particularly after an equities bull market that's run from 1982 till today, are too afraid of their downside and too covetous of the upside. And so they become too aggressive and too speculative. So for me, the concept of a moat around the business, a margin of safety and durable competitive advantage was useful. The thing that served me the best, the understanding, was the section he has on Mr. Market. Mr. Market talks about investor psychology and how most people's timing is pretty good, but they make exactly the wrong decision at exactly the right time. When the price action in a sector has begun to justify the narrative, what happens is that everybody crowds in just at the time when that business doesn't have to get any better. So in Mr. Market, Ben Graham postulates that the market is your business partner in a business. And Mr. Market, your partner, is manic depressive. And one day, when he's feeling elated, he wants to buy your share of the business for twice what it's worth. On another day, when he's depressed, he wants to sell you his share of the business for precisely half what it's worth. And he shows, as we've talked about in previous interviews, that if you have a $10 stock that's doubled in price, when nothing that's happened within the business has changed, despite the fact that it's doubled in price, or rather because of the fact that it's doubled in price, it's precisely half as attractive. But having Mr. Market as a partner, which you do as an investor, you have financial markets as a partner, gives you the advantage, if you can keep your head while everyone else about you is losing theirs, to buy low when they're depressed and sell high when they're elated. And so I would say, for me personally, that was the most important part of the book. Most people don't have the time frames in their mind that are necessary to take advantage of that. Particularly young people, inexperienced, not yet hurt, will say, well, what I want to do is triple my money in 9 months. Well, that's fine. It's a laudable idea. It's not a goal. It's so far-fetched, it's stupid. And people say, I don't want to talk about 5 years. I don't have 5 years. People in their 20s tell me they don't have 5 years. I'm 67 years of age. I got much less time left on earth than they do. And I don't think 5 years is a long time at all. I've been through 11 5-year cycles in my life. With any luck at all, I'll go through, 5 or 6 more. So in order to be a success investing, in order to be success in the Ben Graham style, you have to have the time frame that allows you to be brave when others are afraid and afraid when others are brave. You have to stick around long enough to allow Mr. Market to exhibit his manic depressive side for your benefit.
So that long term, when I think of you and just having been able to interview a lot and then spend some time with you during non-interviews too, seems to be one of the things that I found about you you're so good at. It seems like your long-term view that allows you to basically have no emotional reaction to fluctuations that happen. And I think that was kind of illustrated at the beginning. So you think that that's the most important thing you learned from the book that's made you so successful? Because it seems like you really have that. It's like it's almost like a Zen thing.
Well, it's helpful. I mean, one of the things is I've done this for 45 years. And I understand in the speculative part of my portfolio, which is large, that failure is the price you pay for success. If you speculate, and I love speculating, what you understand is that in speculation, you're taking very high risk for extraordinary reward. And that means necessarily that many of your decisions will be failures, at least partial failures. And if you don't have the temperament, the psychological and the financial ability to accept periodic failures, you will never be a success as a speculator. You need to become an investor. For myself, if I make a decision in the sub 100 million market cap space, my expectation on any individual decision is a 20 or 30% loss. Because I know that the alternative to a 30% loss might be 1,000% gain. And that's really good arithmetic, because 1,000% gain can amortize an awful lot of 20 and 30% losses and still leave room left over for an acceptable rate of return. So I've just regarded, for part of my portfolio, losses to be inevitable. On the investment side of my business, I'm very different. I don't have much tolerance for failure anymore, but I do have a tolerance for time. There are two principal kinds of investment and speculative questions that you can ask. We've talked about this in the past. One is the if question. Is this going to happen? If this happens, as this happens, will this happen? And that's a common question. But a much better question is a when happen, is a when question, where the answer begins with when. If it is practically a certainty that something's going to happen, but you just don't know what time it's going to happen in, that's better than a question where it might happen or it might not happen. And so in the investing side of my portfolio, I ask myself when questions. I focus in natural resources. So that type of question manifests itself like this. If it costs, in terms of total cost, $50, $55 a barrel to make oil, and if the industry is selling it for $40 a barrel, losing $15 a barrel 100 million times a day, sooner or later, either the price of oil is going to go up or my car is not going to start. What do I think is more likely? Well, I think the price of oil is going to go up. Now, because oil's at $40 and because the narrative as a consequence of the price is negative, everybody tries to figure out a way to support their negative prejudice. Greta doesn't like oil. That's one, right? Tesla, the world is going all electric. All that stuff may be true. Greta hates oil. But even Greta, when she walks in a room and hits the switch, wants the light to go on, and she wears a plastic face masks made of oil, stuff like that. I don't want to pick on Greta. But the truth is that peak oil demand probably occurs in 2035. And if the oil price doesn't increase, there won't be any supply 5 or 6 years from now. That's the example of a when question. I know it's going to happen. I just don't know when it's going to happen. Now, I could invest in that theme, or I could speculate in a technology that I can't pronounce, where the outcome is very much in question. In part of my portfolio, where I'm looking for outsized gains, but I'm taking outsized risks, I might participate in some questions where the answer begins with if. But in my investment account, I limit myself to when.
That's interesting. So how much of your account is an investment versus a speculation, and can you speculate within a when? For instance, I can say I feel it's a when that gold and silver prices continue to rise, but then speculating within the when thesis.
Sure, absolutely. I mean, I do it all the time. In answer to the first part of your question, much more of my money now is involved in investment and speculation. I am 67 years of age, and although this is going to sound extremely egotistical to you, I don't need to get rich. I'm rich, right? I've done that. I speculate because I'm competitive and perverse. I want to get richer. I'm good at it. And it's really fun. Really, really, really fun. It's like I'm playing a chess game, but a 3-dimensional chess game, and I'm doing it for money. It's really fun. But I invest much more money than I speculate. I work harder and spend more time at speculation than I do at investing, because some of my investments are truly on autopilot. There are a couple of investments that I've made where I would have to work very, very, very hard not to win. And I don't,
So let me ask you, let's pretend that you were teaching a seminar or a course in a university on Warren Buffett and investing. And I ask you about Warren Buffett because I know that you have learned a lot from him, and that's why you recommended Benjamin Graham's book. What do you think are the most important things you've learned from Warren Buffett, or as someone that is so intelligent and detail oriented as yourself, what do you think people miss about him as an investor and that we should all learn?
One thing that people miss about Buffett is how smart he is. In addition to doing things well and being phenomenally disciplined, he's also phenomenally smart. So don't compete with Buffett. Don't decide you're going to outgun Buffett, because you ain't, okay? But you can do half as well as Buffett on a compounded basis and get yourself stupidly rich with much less risk than other people take. It just takes time. Remember, too, the other day, Buffett had his 90th birthday. And he started investing substantial amounts of money when he was 16 years old. So one of the things that Buffett did right is he forgot to die, which I would encourage you to emulate. But getting back to your question, there are a few things that Buffett teaches that are wonderful. He describes investing as a baseball game, but with no called strikes. You're the batter, you're at the plate, your money is your bat, but there's no called strikes. So the only thing that you can do wrong is swing at a bad pitch. You stand there all day and you look at pitch after pitch after pitch after pitch until the pitcher, which is the market, gets tired and throws you a fat one, and then you whack it. Pass on 100 deals to find one good one, because there's no called strikes in investing. No harm if you miss a pitch. That's really important. What does a fat pitch look like? A fat pitch is a company that has a durable competitive advantage. They do something better than their competitors. It doesn't matter what they do necessarily, but they have to do it better than their competitors. They have to have a cost of capital that's substantially lower than their return on capital employed. It's that delta that Buffett looks for. The delta between the company's cost of capital and their return on capital employed. A classic example when I was younger was precisely that real estate I talked about. I'd buy a building where I could raise the rents at 3, 4, 5% a year, actually more in those days because there was inflation. But my cost of capital was a 30-year fixed mortgage. So my cost of capital never went up, but my rents went up every year. And by the time 10 years had gone by, the delta between my return on capital employed and my cost of capital became cavernous. It was wonderful. So Buffett looks for that. Buffett looks for, hopefully, he doesn't insist on this, but hopefully, businesses with good operating margins, 15% plus, where they have the ability to reinvest that margin at similar rates of return. In other words, he's looking for a business that can generate 15% return on capital employed and reinvest that 15% at that same rate of return. He looked 30 years ago at the margins as an example that American Express was generating with premium credit cards. He looked at the baby boomers beginning to come of age and gather wealth, and he determined for himself that the market for American Express cards, both at home and abroad, was increasing very rapidly. So you had a high margin company that had the best brand in credit cards, which is a durable competitive advantage, that could reinvest the cash that they were generating at the same rates of return. He did the same thing with Coca-Cola. He saw the margins that were being enjoyed on Coca-Cola, and he saw normal population growth, increasing demand for Coca-Cola, at the same time that he saw living standards for people in frontier and emerging markets increasing. So he saw that Coca-Cola had, on a product basis, 80% margins that they could reinvest. And then he also looked for other advantages in whatever form. What he found out is that there are tax advantages to building brands. If you and I invested in tangible assets, we would be able to write our investments off, but over a very long period of time. If you and I invested in a tilt-up concrete warehouse in Vista, California, and let's say we put up $10 million, we would be able to depreciate that $10 million, and I think it's 3.3%, straight line depreciation over 30 years. But if we invested that $10 million in building a brand through advertising, we could write it off in year one. And what he figured out with Coca-Cola is that building a brand was the same as building a building, because the customer, a new customer for Coke, was a customer for life. So the investment had yielded the same duration of return, which is to say the lifetime of the customer, but he could expense the customer acquisition investment. Whereas had he invested in fixed assets, he would have had to amortize them. So brand building conveys a tremendous tax advantage over time, which is something that Buffett learned.
That's really interesting.
Unknown caller.
Sorry, hold on for a second.
Don't worry about it.
Done.
So, do you need to roll? I'll just cut it right there too, and we
It's
can.
fine. It's fine. It's fine. I just turned it off.
Well, I know you're busy, so I don't want to go too long. So, I'll have it cut right when that started, and I'll have it loop back in. My editor pull that. So, then let me ask you. So what you said, I never heard anybody say anything like that in that much detail about really, I guess, small things that were really big things for why Warren Buffett became so successful. Do you think that there's any other ones that if I said, Rick, you're teaching this investing class at whatever university tomorrow on Warren Buffett, what else would you add?
Let's do this, Jake. Why don't you ask your listener base if we should spend half an hour on Warren Buffett sometime? Because I've taught Warren Buffett classes. I'm a huge fan of Warren Buffett. Huge fan of Warren Buffett. And young people need to study Warren Buffett more. Young people think he's past his prime because he doesn't own a Tesla, as an example. And that may be true for technologically sophisticated investors. One wonderful thing I'll leave you with on Buffett before we move on, if we're going to move on, is he said that he needs to understand the business proposition in 10 minutes or less. If he can't understand it in 10 minutes, it's too complex, he doesn't want to know about it. That's part of his fat pitch thing. Buffett doesn't want to have to spend a week understanding something because it would take too much mental capital to keep his understanding of it current enough to own the company. When he talks about Coca-Cola as an example, he said other people look at Coca-Cola as marketing, sugar, and water. And he looks at Coca-Cola as a pleasant experience, as a smile. And he said, you can sell smiles for more than you can sell water and sugar. Understanding that using a 70-year-old formula to sell 6 cents worth of sugar and water for $1, that's kind of all you need to know. It's a really simple concept, whereas if he began to try to understand some technological application, some series of algorithms or some biotechnology thing, while it might have tremendous upside, the probability is that he would get it wrong. He's not a biochemist. He's not a physicist or anything like that. So he wants to be able to understand the economic premise in 10 minutes or less. And I really like that.
You describe a lot of your things in 10 minutes or less. This is how I first got interested in the uranium thesis. You said, let me ask you, what do you think the probability is that I flip the switch and the lights don't come on?
Right.
So,
well, I've copied that from Buffett. There was a point in time when I was a young man in my 20s where I thought that my success and resources was transferable to other businesses, particularly because I'd been accidentally a success in the bar business too. And what I learned was that the farther that I got from things I know about, the more frequently I got spanked. And I got sick of getting spanked, And that's happened to Buffett twice in his life. He's been seduced by the operating margins in airlines at the top of the cycle and by their extraordinary low cost of capital. Twice in his life, he's invested in airlines, and twice in his life, he's lost billions. So he doesn't get them all right.
Interesting. So I know you got to go here soon. So let me ask you, I think that this might be a nice way to end. How would you invest your first lump sum of money? Call it $10,000 or call it 50. I guess it doesn't really matter the amount. How would you invest if someone had their first lump sum of whatever it is, 10K, 50K?
3 things. 3 months worth of living expenses in cash in the bank. Don't invest it. Make sure that you don't have to work for money, to live. The second thing, I think, is can you start your own business? Or do you have your own business? Invest in your own business before you invest in anything else. If you've exhausted that too, if you have $10,000 left over, I would have a hard time not investing $1,000 or $1,500 in physical gold. Because it's insurance. It will allow you to sleep nights and stay calm. I think it's going to go up in price too, but that's not why you buy it. I would probably invest another $1,000 in the best of the best gold stocks. I think they will go up. If I only had $10,000, I wouldn't want to take risks on the game year ones because I couldn't afford the losses that might occur with stock selection. With regards to myself, the truth is that I'm increasingly leery of other asset classes right now because the interest rates are so low. And because financial markets are so strong, relative to the strength I see in the broad economy, that I don't see many things to do. Perhaps in another discussion, I could talk about community bank stocks, which I think are fairly under-owned asset classes, although stock selection is paramount. There are certain boring sectors that are probably very attractive from a risk-reward parameter. But in order to get involved in those sectors, I would insist that the young person who was taking my advice had read economics in one lesson and The Intelligent Investor before they began to allocate.
What percentage of your money are you sitting on right now?
44%. 44% in cash. That's not on purpose. It's because I've liquidated some investments recently and I haven't found anything that fired my greed enough for me to redeploy.
So are you going to sit on it in anticipation of potentially having a further downswing in the stock market?
Hopefully not. Hopefully there are some companies out there which I can find which, irrespective of equity market valuations, are attractive. I know myself that money, I'm losing purchasing power on that money, 1.5, 1.6% a year. And it's not fun. I have way more than I need for my living expenses test. My own living expenses is a year, and mercifully I don't spend much, and I have lots. But irrespective of where the markets are, remember that a share is a piece of a business, and there are circumstances where, irrespective of market conditions, there are some companies that are selling at substantial discounts to intrinsic, and those should be bought irrespective of the time. It's just I can't find many of them right now.
So did I catch you just say that your goal for yourself is to hold 1 year's worth of your money in cash? Is that what you said? Did I hear that right?
Yeah, I mean, after people have gotten 3 months living expenses, that's good for young people that don't have very high living expenses and have reasonable incomes. But after you got a family, as an example, as soon as you can afford it, you need a year's worth of living expenses. I'm assuming, on your video that I'm talking to some, very young people just starting out, and asking them to have a year in living expenses is an unrealistic ask on my part. They're single. I remember when I emigrated to Canada, all of my earthly possessions fit in half of my Toyota pickup truck, and I could sleep in the other half on the way up. 3 months living expenses was not a lofty goal for me at that point in time, because when I was on the road, I slept in church parking lots. I didn't have any living expenses.
So 1 year is a good next goal. I know it's been about an hour, so you got to go. Let me ask you a brief question. What book are you reading right now? You said to set the goal of reading one book a week. I think I'll set that goal for myself, and I was curious what you're reading.
I'm embarrassed to say right at this moment, because I'm moving into a new house, I'm not reading any books at all.
What was the last good book that you finished?
One that's really worthwhile, a big picture book, is Sapiens. But actually, what you should read, have you ever interviewed Doug Casey?
No, I would love to, though.
Yeah, Doug has written a series of financially oriented science fiction novels where he has shown that many people in society who are cast as villains are heroes. And I think you should read, there's two of them. The first was The Speculator. And in this book, he shows how a young speculator who is reviled by society for figuring out information that other people were too loathsome and stupid to figure out, why this guy was a hero when society made him out to be a goat. And that was a pretty good book. The premise is good. I'm a speculator, so I admire speculators. But his second book was called Assassin. And that's a much better book. And he talks about the fact that in society, there are some people that probably deserve to be killed. And that the people who kill them are provided that they choose their targets well and create no ancillary damages, heroes. And so, yeah, I would advise you and your audience, because I think it's largely a libertarian audience if they listen to me. I think they should probably do themselves a favor, have some fun, get to like reading, maybe intersperse The Intelligent Investor, which is a bit dry, with Assassin, which is anything but dry.